Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for March 15th, 2014. The market remains in bullish normal conditions on an annual basis using weekly RSI 14. We're in the middle of neutral at 62 out of 100. Short-term condition on a 10-day basis using the 10-day NDX, we're oversold at 17 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is 6.78% or red bullish. We have about just a little under 5% cushion to sideways market. Slope of the 50-day moving average degraded to red bearish at plus 0.11. ADX started to lose some of the trendingness this week, down to 19.1. ATR percentage increased slightly to 0.93%, although we're still in a normal condition. The risk index is the 30-period moving average of the VIX divided by the 10. That value is 1.01, so it's still risk-on conditions. However, we've pulled back on that measure. You take that score of 1.01, compare it to the last 5,000 trading days, take the z-score, you get the risk z. That comes in at a value of 0.10. This is a time series of the last 90 days. You can see that smooth oscillator has come back to the zero line. We're right on the boundary of risk on and risk off. The last two times it's pulled back, there has followed a period of sharp volatility that has been good for intraday trading using VXX or UVXY. So we'll be alert to that. No change in the holdings in the blended monthly rebalancing system. And these are the current leaders based on the different populations that we track. The top 3 for the ETF portfolios, the top 5 for the Dow plus Alcoa, and then the top 10 for ETF 200 and ETF Max. Inside ETF 2, the theoretical exposure is at 50% and the model portfolio is at 50%. Correction, that should be 100%. This is a quick look at the ETF 13 and 32 portfolios. About half of them are on buy positions, mostly dominated by the U.S., led by real estate, small caps, mid caps, tech, and the globals are suffering below their 4-month moving average, and that's the same story in the 32 ETF portfolio with healthcare, utilities, and agriculture now outperforming the real estate. And again, it's the internationals that are suffering here compared to their 4-month moving average. In ETF Max, this is a EMT is an anomaly here. That was a reverse split. I didn't catch that error until now. But it's still coffee, gold, solar, agriculture, biotechs, Indonesia, silver miners, and silver. So maybe we're seeing continued life to be breathed into the precious metals area. Next up, the market health check. The vertical blue lines represent 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that have held in the past and are resistance levels on the way up, and profit target lines on the way down. We just reversed from 189, have come back and are seeing if we can hold support here around the 185 area. I no longer have a default long-term bias. We're back into what I feel like is the yellow zone inside the river mostly. And I'm taking my intraday directional movement to be based off of the intraday movement of the S&P. So on these 2 days with big red candles, I was short predominantly, and on days with white candles, I'm tending to be long intraday. And I'm looking for measured reward and risk and less likely to hold overnight when when I see the markets in yellow conditions like it is now. Next target on the downside vicinity, the Bollinger Band mean, which had been a support level all the way back here at the start of the year. The dragon has moved from outside the river past the far side and is now rolling over. So this is looking more like choppy market conditions. The regression lines, the three channels, the first one, the 10, the short term has rolled over. The 30 is still very steep, although it has started to roll over, as you can see in this blue circle is the turning point of the steepness of that 30 period regression line was hit 3 days ago. The 90 is this long green one, still long and strong. We are just at the midpoint of the long-term, the 90-day trend. We're testing the bottom here of the 30, and that's why, to me, this is a really important price level to find support at here. We've pulled back, like I said, from 189 to 185. That's a That's about a 2.5% pullback. So this is still within the noise channel. A 5% pullback will get us down around 180 or the bottom of the river, and that's really noise from about 180 and above. We've come down into oversold conditions on Williams percent R, so that's going to set up a bunch of signals for the channeling and the overreaction signal systems. And you can see that the jaws of PPO have closed from this 30-day move up. They closed here and now have opened to the downside. So the possibility for more suffering on the downside is there. However, let's see 182. That's why this is so crucial in here. If this support level over here holds, then this will still look favorable in the long term. All eyes are on Crimea, and we'll see if there's any effect from Crimea in the markets here. So, markets at indecision. This is a great location for traders, and we're open to strong trades in either direction. I would just remind you that it's these counter trend days in trending markets that offer such the great rewards in the frog style of trading. You see these great big 1-day red candles like here and like in here. The frog just has been a very reliable trading strategy on those kinds of days. ETF2 regional report. 5 of the 10 regions are on cash signals, so that drops us from 70-30 down to 50-50. Still bull normal. The S&P at 43 is better than EFA, the globals, at 40. The S&P at 43 and Europe at 43 are kind of tied. Japan's suffering. Inside the U.S., it's this should read small caps, then tech, then mids, then large. The two strongest sectors, technology and small caps, and the two weakest Latin American emerging markets. Still strength in utilities and healthcare, the defensive sectors. Materials are doing okay. Suffering in energy and consumer staples, however. World market model. Now we expand to look at regions and individual countries. All of the U.S. is above average, less the Dow. The European overall is above average, but now some of the refined sectors are starting to suffer. You can see weakness coming into Europe, except for Spain. China has pulled off the green, now back into the white. Indonesia and Vietnam doing well. Gold, silver, treasuries in response to the uncertainty in the geopolitical markets. U.S. real estate holding up well. Basically a tie between the global and the U.S. business sectors with a slight hat tip to the U.S. Healthcare is still holding up stronger than anything. Canadian dollar still weak. Top ETFs based on the ETF 2 framework. And those that are in green and then white are new additions to the leadership. So junior miners, gold, silver. Notice the trend. Indonesia is even, well, you don't see that very often. Green and then yellow. So and then more Indonesia. Agriculture, mortgage REITs, microcaps, pure growth, RPG. So some interesting new plays in here. Look at the average volume in here, 35 million shares on average a day among the gold miners, GDX. And then the juniors over 2.5 million. In the Dow, you can see the shift away from the green down more towards the yellow. Last week there were like 7 in the green. Visa's starting to weaken. It's green on consistency but white on strength, and that's the same with American Express and Caterpillar. At the bottom, Chevron, Walmart, and Travelers suffering. And just a quick look at ETF liquidity of the top and the liquidity and volatility of the top 30 ETFs based on average daily dollar volume. The VIX is getting got an increase in its ATR percentage, so getting some range expansion as it's been doing pretty well the last week or so during this pullback. Just a couple additional slides just to share with you. This is a chart that uses the 3-line break system. You can or 3-line break method for drawing candles, so it's a little smoother. It smooths out some of the noise of choppy time frames. So in that sense, it's like it's similar to the point and figure. And so this is my quick look at the S&P. So this is the S&P as of Friday, and these are based off of daily charts here. So the swing high at 189, a 5% pullback gets us down to 181. That's before we talked about the crucial 180-ish area. So anything from 0 to -5 is truly noise. 5 to 10, trading opportunity in a bull. This to me is that line in the sand at 174. If that thing really fails, man, it gets really horrible down in here. So you can't. I don't think you can wait that long to find out if it's going to hold. Yeah, are pullbacks buying opportunities? Sure they are. This one was. Well, actually, this one was. This one was. These two were. This one kind of was. That one certainly was. So is this a pullback opportunity? Well, you have to treat it that way. Otherwise, you can't trade or time bull markets. And so I'm looking for places where can it find support, where can it find a reversal. This is the first natural place right here at about 185. So we'll see in the daily report there's a lot of symbols that are setting up for those kinds of buy strength on pullbacks. But I think you see here just how smooth that 3-line break system of drawing candles is at finding support and resistance levels. Just by comparison, this is same strategy, but now using the Dow. And you'll notice that it is relatively weaker compared to the S&P. We saw on the market health check that the Dow was in the yellow, whereas the S&P was in the white, slightly above average. So the pullbacks go farther. It didn't make a new high compared to the previous swing high off this move here, and it's fallen deeper into the channel. But otherwise, we sort of have a parallel construction. And this is where the 10% pullback in the Dow would be. 5% around 157. And again, the Dow is also at a natural place for finding support. And then the upside target's 165. It's got to break through that. Okay, we're going to shift back to the daily report now for Friday, looking into Monday. Quite a few pullbacks, signals for overreaction and channeling, as I noted earlier, would be the case. You can see how volatility came back to the 6-month normal, or 100-day normal, excuse me, and is now finding support here. Tons of favorable patterns. The auto framers are the ones that test out better than 2-to-1 on a reward to risk, just on the basis of trade location. So should be able to find some of your own favorite targets inside this stack. And again, just so much to choose from. Lots signaling on the RSI2. Plenty of froggy types of candidates. Friday's action had some favorable doji qualities. And then a lot to choose from that test out better than 2-to-1 on the auto framer. And in the ETFs, that's going to be the same case also. Plenty of signals on RSI2 that test out well. Many dojis channeling and overreactions. This is a target-rich environment you can see here from the auto framer. So too many to go through. So you can be very selective about finding the ones that really conform to your beliefs or to your market context knowledge. Which ones do you like to trade? Trade your favorites, is what I'm saying. In the market mosaic, you can see it's this 30-period regression line in the blue, the exponential one here, and how the price has cracked. But it did end in a doji, so this would be a natural support level here, around 185. Got to be concerned about a potential to the downside, but that's what makes it a good swing trade critical state, is the fact that there's plenty of people eager to trade on both sides of the trade here, because you can frame a reward to risk ratio favorably in either direction. Because if this price level cracks, then we would expect to see 179 or 178-ish on the downside. So lots to choose from. All right, that's everything I want to cover from the weekend report. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.